also why I brought our special guest on today. Okay, so Chris Wilkins is an expert tax advisor. Not just in this line of work, but in lots of different industries as well. He's got a very, very prominent career, which I'm sure he's going to talk to you about as well. But can we all give a massive round of applause to Chris? Pleasure, the stage is yours.
Hi Paul, thank you. Right, good morning. Great venue, and hopefully we can have a chat for about an hour. And what I was going to do is I'll talk to you a bit about what we do. Then I was going to explain where we are on the tax horizon. I'll let you know what Rachel Reeves is going to do in the autumn statement on the 30th of October, because I think some of you may be interested in that. I'll give you some ideas on tax planning, type of different structures you can have, different entities, how they're taxed. And then at the end we'll have some questions, so you can then sort of run through anything you've got. I guess you might have something that's relevant. So Wilkins Southworth, so I'm the managing partner. We're based in Barnes, southwest London. We're chartered certified accountants, registered auditors, and we do tax. So you may have noticed from there that we've done everything where we acted for the largest telecommunications business in St. Petersburg, Russia. We've acted for the largest landowner in Bucharest, Romania. And I was the CFO of a company on the Vancouver Stock Exchange. And we do personal tax for people, accounts, audits, etc. Now you could say, well, how did you end up sort of having such a diverse portfolio? Well, my wife said that if I was a woman, I'd be permanently pregnant because I never say no. So sort of the problem then is that one of my mates from Bristol, Devon, sorry, he said, oh, well, I'm getting into business with this guy that's buying land in Romania. Can you help us? Because there's a double taxation treaty. And he says, I know you've done double taxation treaties with Russia before. And some of these are quite useful. So like, we've got some clients that want to go over to Cyprus. Well, Russia and Cyprus used to have the best bartering regime. Because they have the best bartering regime, that means they've got the best double taxation treaty, which means that there's a lot of Russians in Limassol. And so, as you may have gathered, there's a lot of people that want to leave the UK at the moment to go to far-flung places. Well, then the question is, if I go to Cyprus, do I end up having to pay tax on my income? When am I resident, when am I not resident? That type of stuff. So when this guy said, I'd like to introduce you for the chap in Devon, and I said, yeah, that's sure. So we had a chat, and he said, well, I said, look, you probably want a local accountant. Why don't you go to Exeter, go to one of the biggest firms and ask them if they can help you with double taxation treaties with Romania? And he came back and he said, no, they won't. I said, all right, what about the second biggest firm? And he said, I've been there and they won't either. So I got my briefcase, jumped on a plane, went to Romania. And that's how we ended up doing double taxation treaties in Romania. Because if you've done one with Russia and other ones, they're not massively similar. Each one has foibles. But if you've got a UK company and a Romanian company, what you don't want to do, suffer tax there and suffer it again there, which is double tax. And that's where a double taxation treaty comes in. So you sort of got to make sure that you can avoid stuff like that. With regards to tax, we do everything from personal tax returns right up to the complicated stuff. So give you an example, something like Code of Practice 9. Code of Practice 9 is about the most complicated revenue inquiry you've got. We've done some of those, and the example I'd probably give you is Lester Piggott. So you may be aware of the jockey, Sir Lester Piggott, and Lester had a revenue inquiry, and HMRC opened a revenue inquiry, Section A inquiry, pretty standard one. And they said, Lester, where'd you get this income from? He said, well, on the Wednesday, he said, I had a race in Kempton Park, then I jumped on a helicopter, I went to France, I had a race near Orly, and then at the last race of the evening, got a helicopter back to Ireland. And they said, hold on. Multi-jurisdictional, that's got to be Code of Practice 9. So Code of Practice 9 is where you culminate in, you give a list of all your assets and liabilities to HMRC, and you basically put your hand on Hansard, and Hansard is the book that basically covers everything in the Houses of Parliament. And you give them a list of all your assets, all your liabilities, said, look, I've been totally upfront, and you have to then present that to HMRC and say, this is a full disclosure. And it's a civil fraud, so it's not a criminal offence. It only becomes a criminal offence if you lie. So Lester gave them all the list, and the story goes, I wasn't involved in this, but the story goes that he had a tax bill of the revenue said, look, you owe us about 480 grand. So he said, bloody hell. He said, let me check it with my accountant. So the accountants checked the numbers, said, yeah, looks about right, 480 grand. So Lester wrote me a cheque. The only trouble was, he wrote me a cheque on a bank account he'd never disclosed. So Sir Lester Piggott ended up being Lester Piggott. He lost his knighthood and ended up in jail because it goes from civil fraud to criminal offence if you lie after going through all that lot. And that is a Code of Practice 9 inquiry. So, so that's the type of stuff that sometimes we've done Code of Practice 9 inquiries before. With regards to the aspect on capital gains tax, a lot of people say to me, well, if I leave the country, then I probably haven't got a tax bill, have I? I probably haven't got a tax issue. So if I left the country today, the problem I've got is that I'm potentially non-resident for a number of different taxes. So if I left the country today, 29th of September or 28th of September, wherever we are, I'm potentially non-UK resident if I haven't got UK property, and I don't come back to the UK. But if I come back before the 5th of April 2026, I have got to be out of the UK for a full tax year to be non-UK resident for income tax. Then if I come back, it's as if I've never been away. Because unless you're away for a full tax year for income tax, you're not treated as non-UK resident. So that's fine. They could say, well, that's fine. I could sell my company and stay away for a year. But unfortunately, it doesn't work for capital gains tax. Capital gains tax is a 5-year rule. So the 5-year rule is that some people could come back. So I could leave the UK today. Let's say I sell my shares in my company after the 5th of April 2025, i.e. in the new tax year. But if I come back within 5 years, I'm then treated as subject to capital gains tax because there's a 5-year tail to it all. So what you've got to be careful of is which tax is going to trigger and how is it going to trigger. So just to go back a bit where we are in the tax environment, the government at the moment have borrowed about £2.7 trillion. £2.7 trillion of debt is equivalent to 100% of GDP. That is, the gross domestic product of this country in 1 year is about £2.7 trillion. Our debt has never been as high as this since 1948. So the trouble you've got is there is no wriggle room for the Chancellor of the Exchequer. The government brings in about £787 billion with a B, billion pounds of tax each year. But of that, 75% of that number is represented by VAT, income tax and national insurance, which they said won't be increased, despite the fact that they increased VAT on school fees by 20%. But they say they won't be increased. So that leaves them very little wriggle room of what to do. So the remaining taxes are predominantly going to be capital gains tax and inheritance tax. Now, as a lot of you guys may know from share dealing, capital gains tax, if it is taxed as a capital gain on shares, is quite difficult and quite complicated. And if there is a revenue inquiry, it can drag on a long time. So capital gains tax doesn't bring in that much money. There's been a lot more inquiries raised on inheritance tax. And inheritance tax are things like, mainly you only pay two main capital taxes. You pay capital gains tax when you're alive and inheritance tax when you die. So if I buy a property, say I bought it 10 years ago, and let's say I bought it for £100,000, and let's say today it's worth £500,000. So I've made a capital gain of £400,000. So capital gain is low, and this is my second property, so I rent this out. So up to the March budget, Jeremy Hunt reduced the capital gains tax on second properties on the capital gains. This is properties you rent out, not trading. He reduced it from 28% to 24%. So if I sold that property, I'd be paying 24% on the difference between £500,000 and the purchase price of £100,000. And I'd much rather pay that than if I died, I'd been paying inheritance tax, assuming I've used up my allowance of £325,000, of 40% on £500,000, because inheritance tax is levied on the market value of the property at the date of death with no reduction for the purchase price. So it's 40% on 500,000 as opposed to if I gave it to my son or sold it to a third party. So if I give it to a connected party, family member, it's deemed to be sold at the market value. So that means if I gave it to my son today, then that would be levied, capital gains tax would be levied at the rate of 24% on 400,000, 500,000 market value, less £100,000. Now with inheritance tax, the reason there's a lot more inquiries going on at the moment is because if I died today, my son might say, oh, well, that property's worth £300,000. And HMRC, if you are the executors have a personal liability on attesting that those figures are correct. So HMRC could then come along with the form of the district valuer and he'll say, I don't think that is £300,000. Let me check. Well, I think it's worth a lot more, £500,000, in which case the 200,000 difference is subject to 40%. But the trouble is that the executor could be personally liable for that. That's why it's very important that you want to be aware of what you're taking on if you become an executor of anything. So there are a lot more inquiries on that, especially say London properties, where the properties are just passed to family members, not sold to third parties. If I died today and the property was sold to a third party, then that's the arm's length transaction because that's the value of the property. If it's taken over as a family member, say my will says I leave property 1 to my son, property 2 to my daughter, property 3, then it's all in the family and there may be a bit of scope for jiggery-pokery with prices. So there's a lot more revenue inquiries on that at the moment for inheritance tax. So with regards to the budget, what Rachel Reeves is probably going to do is concentrate on the three main ones is probably capital gains tax, probably inheritance tax, and probably pensions. So with capital gains tax, if you have a trading business and if you own more than 5% of the shares of the trading business, so to give you an idea, I like to do my tax planning in advance, so I've got 18 kids. This is a joke, by the way. So if I've done that in advance, 18 kids, the wife and me, that's 20 people. We each have 5% of a limited company, and as long as we are all directors or employees, we would all qualify for business asset disposal relief. Business asset disposal relief is a reincarnation of something used to be called entrepreneur's relief. Entrepreneur's relief is where you could sell the shares in your limited company as long as you qualified, i.e., I won't tell you the old rules, I might as well tell you the new rules. As long as you qualified, you get £10 million and only taxed at 10%. The new rule, business asset disposal relief, is you must have a trading company. You could have a partnership or a sole trader. You must own at least 5% of the ordinary shares of that company. You must be a director or employee. And when you sell those shares, those three rules must have qualified for the last 2 years. So what that means is if I sold my shares, then the first £1 million would be at 10%. But because I've got 18 kids and a wife, they're all going to get £1 million. So I could sell my business for £20 million and everyone pays 10%. Now, unfortunately, my tax planning didn't extend that long. I wouldn't have afforded the school fees, but that's the theory. So you could pass it around people that work in the firm, etc., etc. Could be an incentive for people to stay. Now, the government reckon that cost them £1.8 billion a year. Bearing in mind, entrepreneurs' relief had a relief at £10 million at 10%. It's now £1 million at 10%. It's going like that. It could be, that's the end of it. The next thing is that what is being touted is capital gains tax. They say, well, we're going to bring it in at the same rate as income tax. And you say, typical Labour Party. That's exactly what they do. But believe it or not, 1988, Nigel Lawson did exactly that when he was the Chancellor of the Exchequer of the Conservative Party. 1988, the highest rate of income tax was 40%, so that was the rate of capital gains tax. 20 years later, Gordon Brown reduced it to 18%. Now, so there is a principle for that, and the reason is, let's assume I'm a high rate taxpayer. So that means that the first £12,570 of my income is tax-free. The next £37,500 take me to just over £50,000 is taxed at 20%. The next level of income between 50 and 125,000 is taxed at 40%. Above 125,000, I'm taxed at 45%. However, what you won't find in any of those figures is a marginal tax rate of 60%. And the marginal tax rate of 60% is if I earn £2 over £100,000, my personal allowance is reduced by £1. So that means if I earn between £100,000 and £125,000, at the top level of that, £125,000, that's £100,000 plus 12,500, my personal allowance times 2, which means in that bracket you're paying 60% tax. Above 125,000, you lose your personal allowance completely, which means the first pound of income is taxed at 20%. Unlike capital gains tax, where it's not a graduated scale. If I make a capital gain, say I sell shares, and say I make a capital gain on those shares, whether that capital gain is £20,000, £200,000, £2 million, it's still 20%, assuming I don't qualify for bad art. So what they're saying is we might bring in a graduated scale, and that graduated scale may mean that the people who make larger capital gains will be taxed at a higher rate, which is the argument that they were talking about that Nigel Lawson used in the 1988 budget. So that may be something they would do with capital gains tax. However, like I say, what you've got to be slightly careful of is the Laffer curve. Anyone heard of the Laffer curve? Laffer curve is basically just think of an upside down teacup. And what you've got to bear in mind with the Laffer curve is if I go back to the late 70s, early 80s, the highest rate of income tax was 83%, and there's an investment income surcharge of 15%, which means, and one of my older clients suffered tax at 98%. Well, 98%, all that happens is the Laffer curve says, well, people will walk, and that was what they called the brain drain, and people just left the country. So you've got to think as when you say, well, I think it was Dennis Healy said, I'll tax them till the pips squeak. Well, fine, but everyone said, yeah, you can do what you want, but I'm not going to be here. I'm going to clear off. Where are you going to go? Well, one of my clients said Cyprus. What has been popular is Portugal. You can have habitual non-residents, and you could pay 100,000 euros. And that means if you're over there, 100,000 euros a year. Now, you might say 100,000 euros a year is a lot. In Italy, they've just increased it from 100,000 to 200,000. But that's everything. You might say, well, that's a lot. Does anyone know the largest private company in the UK? i.e. not quoted. Now, if I didn't know the answer, I probably would have said Dyson. Dyson's got a turnover of about £6.7 billion. However, the biggest company is Ineos. And those of you that follow football would be heard of Jim Ratcliffe, bought 25% of Man United, that's through Ineos. Ineos turnover is about £67 billion. Jim Ratcliffe left in 2018, left as a resident of the UK, and at that stage he was paying £111 million a year in tax. So what you've got to bear in mind, in this country, nearly 50% of this country pay no tax whatsoever. The top 1% of taxpayers pay 28% of all tax. So that means that if the top ones take their laptop and go and sit on a beach in Portugal or Italy, then who's going to pay the tax? And that is the trouble. That's what you've got with if you tax them. The Laffer curve says if that's your upside down teacup, if you go too far along there, that's the rate of tax, then all the people who pay the most tax will just clear off. And in Jim Ratcliffe's case, he's saving £111 million a year. So it's those guys that you've got to sort of keep sweet. So the government, I think they're going to sort of row back on some of the things you read in the paper, because you've got to sort of keep the rich paying the tax, because, like I say, nearly half the country pay no tax. So that's the sort of the quandary the government in. The government have no wriggle room because the government debt, £2.7 trillion, is 100% of gross domestic product. So they've got to try and tax you without taxing you in a detrimental manner. Easier said than done. You might so they're bringing new things in: sweet tax, plastic packaging tax. If you go to New Zealand, they're having a tax on farmers for all the cows and sheep that belch and fart, and it's a methane tax, and because they pollute the environment a lot. Now, you could say, well, we bring more taxes in, but then the trouble is people are just, like I say, the rich ones who are peripatetic can just take their laptop and go, and that's the trouble they've got. So it's quite funny. Rachel Reeves says, you may have read in the paper, she said, the Conservatives left us with 20 billion black hole. Well, 20 billion is a lot of money, but to give you an idea, that is less than 3 months interest for this country. We pay £83 billion a year just in interest on our debt. So 20 billion is a big number, but compared to some of the other government figures, it's not going to bankrupt the country. The money going in and out is just massive, and that is sort of just less than 3 months interest for this country on government debt. So it's just a case of trying to make it work. Now, with regards to inheritance tax, at the moment, If I give money away from me personally, it's a PET, a potentially exempt transfer. It's potentially exempt because I've got to live 7 years. If I live 7 years, it drops out of my estate completely, no tax on me, no tax on the donor, no tax on the donee. It's completely out of the estate. So what they are thinking of doing is bringing lifetime inheritance tax. So they might say, I've got a hotline to Rachel at the moment, but it could be a lifetime limit, I don't know, 7 million. And then you can give it away whenever you want, no tax on it, and anything above that will tax you. So at the moment, I have an exemption, as do you, of £325,000 for inheritance tax. I can then get another £175,000 if I gift my property to my kids. That's my principal private residence. And if my estate is less than about £2.3 million, then I can get that other £175,000. If it's more, I can't. So that means that basically 325,000 plus 175,000 is 500,000. So the wife and I have £1 million that we can give away. Anything above that broadly is going to be subject to 40% tax unless you can claim some exemptions. So some exemption is something like business property relief, agricultural property relief. So if I wheel back to Dyson I think he owns more land than the King, more farmland. And the reason is at the moment it's protected for inheritance tax. So the idea is in the old days, is that if I had a farming community, as this country was in the old days, if you had to pay tax on the farm every time you died, you'd end up with such a small farm it wouldn't be profitable to do. So that's why that exemption was brought in. Business property relief, what they're saying is that is my trading company. So I've got a trading company, firm of accountants, that's classed as a trading company. That will be exempt if, when I die, it's still trading. If I sell it today and put the money in my back pocket and die tomorrow, it's no longer a trading company because it's cash. So the trouble is with BPR, business property relief, is it also extends to the AIM market. So if I knew I had a terminal illness and say I was going to die in 3 years' time, there's no benefit in giving money away because I can't live 7 years. However, I could invest in the AIM market in shares. Lots of shares on the AIM market, a lot of them going down actually, like Boohoo and things like that. But there are shares. If you wanted to, you put your money in there, live 2 years, and it's free for business property relief. And that's one of the things that they said, well, they might get rid of that as well. So that's inheritance tax. The other one is pensions. So let's assume I'm a 45% taxpayer. So every year I put money into a pension, and every year I get 45% tax relief against my income tax bill. If my company did it, then the company would get relief. The difference is if I do it and I'm a higher rate taxpayer, I'm getting tax relief at 45%. If my company does it, used to get tax relief at 19%, now it's 25% if my profits are above £50,000. So I would then be getting tax relief at 45%. When I retire, I could draw down that pension and I'll say, actually, the wife and I, we're only going to draw £50,000 each and I haven't got any other income. So that means I'm a 20% taxpayer. So when I retire, my pension is subject to 20%, but I've had 45% tax relief. And by the way, there was a maximum of £1,073,000 for your pension fund. Jeremy Hunt's removed that in the last budget, so you can have a greater pension fund. 25% of that fund, up to a maximum of £1,073,000, is tax-free. So I could take 250 grand, put it in my back pocket, pay no tax on it. And then what happens is if I took the 250, didn't draw down the pension and died, I could leave that, which is in a trust, in a pensioner trustee, I could leave that to my kids, so therefore there's no inheritance tax payable on it. So they would receive the pension, and they and on drawdown, they might be 20% taxpayer, I might be 40%, I've had 45%, I've had 45% tax relief on my pension contributions throughout my life. I've taken 250 grand because if I've got a pension fund of £1,073,000, which is the maximum you can draw down 25% on, then you can take the 250, put that in your back pocket, and that's tax free as well. So there's a lot of this where you could see the scope for that being attacked as well. And like I say, business asset disposal relief, the capital gain relief, they reckon that's £1.8 billion that it costs them a year. Pensions are in the high billions. they've got to be very careful though, because if you have older people, all their life, they have worked on the assumption that when they retire, they're going to get 25% of it tax-free. So I think it would be a bit pernicious if they change that rule today. They might change something going forward. They might say, from now on, if you make a pension contribution, you're only going to get a maximum, let's say 30% tax relief, not 45% tax relief. If you're a high earner, you are restricted to putting a maximum of £10,000 in your pension anyway. If you earn less, you can put up to £60,000, and you can go back you can use unused allowances for the previous 3 years plus this year. So there's quite a lot you can do. We're advising our clients that if they've got money and want to make a pension payment in the year ended 5th of April 25, they do it before the autumn statement on the 30th of October. So you just want to make sure you can take advantage of any allowances and reliefs you've got, so you can use those now. So they're probably the biggies in the autumn statement on the 30th. But somehow what they've got to do is they've got to raise the taxes to, their debt is so high, it's just think you've got a massive great mortgage and your mortgage is more than what you're earning a year. And it's sort of a bit like that, and it's got to be brought down because the interest debt is horrendous. They could have, believe it or not, they could have fixed their interest and they never bothered. It's a bit like me fixing my mortgage. I'd want to fix it before interest rates went up when they were benign. I'd take a 5 or 10 years fixed, but the government didn't do that. So what you've got to do is you just got to plan accordingly, and unfortunately the money that's seeping out of this country is just enormous. So what I think they're going to row back on some of the things for the high earners, because you need the high earners in the country, you need them to pay tax. And it's just a case of trying to find ways around that. And so then the ways around that is, if you are earning a lot of money, is how do you structure your affairs? Now, broadly speaking, from an income tax point of view, I need money to live on. So either I have a sole trading business, a partnership, the 1890 partnership. So while Bill Hickok was shooting up Dodge City, we were doing the 1890 Partnership Act. Very simple, 2 or more people in business, and that's it. The next precursor on that is something called limited liability partnership. A limited liability partnership has the same protection as a limited company. The accounts are filed at Companies House, and you get protection of the value of incorporation. So what that means is, if you enter into a contract and that contract is by your limited company or your limited liability partnership, the contracting partner is your limited company, your limited liability partnership, not you personally. Therefore, you are protected from being sued, subject to certain things, i.e. health and safety. You can't avoid health and safety. What that broadly means is that if I've got a partnership, limited liability partnership, sole trader, I'm taxed on income tax. So any money I earn is taxed on me. If I have a limited company, the money is taxed on the company, and then I take the money out. So what we do with a lot of our clients is, people come to us and they say, I've got this limited company, and I say, how much are the profits? And they say, the profits are, let's say, £400,000. How much do you need to live on? I need all of it. Okay. So if you need all of it, the company's paid 25% on the profits. So the company would have paid 25% corporation tax on the profits of 400,000. That's 100 grand gone straight away. And you are then taxed on the 300,000 that's left. How are you going to take it out? Well, I'm going to take it out by dividend. Dividends are taxed at 39.35% on that level of income. So 39.35% plus 25% corporation taxes, you've got an effective tax rate of nearly 65%. That's because it's your limited company. Your limited company has paid corporation tax, and you're taking the money out of your limited company for you to live on, so you suffer income tax. And the highest rate of dividend tax on that level of income is 39.35. Now, if that person came to me, I'd say, okay, why have you done that? Oh, my accountant told me. Because some accountants like that rather than like that. So what you then need to do is think of a better structure. So we had a client that came to us, and I said, out of interest, do you drive a car? Yeah, I've got 2 cars in the company. What have you got? A Porsche and a Ferrari. what's the P11D benefit in kind on that? Bloody enormous. And so the company has company cars. If you use a company asset, even though it's your company, then that means that you are using a company asset, there's a P11D benefit in kind. P11D benefit in kind means the company pays employers NI on that benefit in kind, and you pay PAYE tax. And that is added to your dividend income and other sources of income. So that is added to your tax bill. So that's your company letting you use the car that you own. So if you had something like a limited liability partnership, there is no benefit in kind because there's a look-through. Limited liability partnership is only taxed as income tax, so the maximum rate is 45% rather than 65%. And if there's cars in the limited liability partnership, there is no P11D benefit in kind because the partnership is a look-through for tax. That means that it goes straight on your personal tax return. And because you need all the money to live on, why are you paying corporation tax, then income tax? So you suffer two lots of tax. If you had just one type of entity, and you might say, I need the protection of the value of incorporation. So a limited liability partnership set of accounts is broadly the same as a limited company. It's just that it's taxed differently. You'll still be able to look at Companies House and see those accounts, and you'll be able to get an idea. So anyone can look at Companies House at the moment, and you will see broadly a filleted set of accounts, which is slightly less information than HMRC get and you get, because it doesn't have detailed profit and loss accounts, but you can look on there. So what you need to think about is the structure that you conduct your business through and whether that is the right structure for you. Now, if we go extend it a bit, and let's say this client came to me exactly the same circumstance, but the profit was 4 million and he needs £400,000 to live on, then I wouldn't say you put 4 million in an LLP, because 4 million means that you're going to pay 45% tax on 4 million, and you only need 400,000, or in this case 300,000 after corporation tax to live on. So what you'd then want to do is you'd have the 4 million in the limited company less 400,000 that we could set a structure for the LLP, because that's the entity that will fund your costs. So therefore you could end up with two entities, a limited liability company, limited liability partnership. That's because if you've got excess profits, the maximum rate of corporation tax is 25%, and you don't need £4 million a year to live on. So you don't want the 4 million taxed at the 45%. But then by structuring your entities, you can get the best tax result. So then what you need to do is think about, have I got the right structure and how does that work? Now, with regards to that, a limited liability partnership, you need two people. So it could be you, your partner, your spouse, whatever you want. But then you can claim expenses that may not necessarily be tax deductible in the company. So broadly speaking, if I was an employee of a company, the expense has to be wholly, exclusively and necessary for a business. If it's a limited liability partnership, a limited partnership, sole trader, it just has to be wholly, exclusively for business. So the point is, if my business address is my home address and I came here and I got a gold Rolls Royce to give me a rented one for the day, is it wholly exclusively for business? Yeah, this is a business meeting. Is it necessary that I had a gold Rolls Royce? I could have got the tube like I did. So that's the different rule. If you've got a different rule, then there's less expenses you can necessarily claim in a limited company than you can claim in some of the other structures. So you just got to make sure that you're aware of how the structure works, because it can significantly make a difference. So on our website it says it's not what you earn, it's what you keep. If you have the wrong structure, it could cost a lot. So we had my wife's friends round about a year and a half ago, and we had a drink with them, and I said, what are you doing now? He said, oh, I used to work for Sky, I'm just retired. I was on PAYE there for about 20 years. And the wife and I have just sold our house, and we bought a guest house. I said, fantastic. How are you structuring that? Oh, it's really simple, I'm an accountant. So he said, we're just going to set up a company and we're buying the guest house, and it's brilliant. I mean, it's so simple. So I had to think about it. And so if you're interested, it's on our website. We've got Wilkins Southworth YouTube and Wilkins Southworth website. And if you look at it, there's the article there. So I had to think about it, and I said, that is so massively the wrong thing to do because they've done that. So to give you an idea, they live in the guest house. They've sold their house, their principal private residence. So by buying a guest house, they can get principal private residence relief, even on part of it, because they live in part of the guest house. If the guest house is owned by a limited company, you can't claim that relief because the owner of the guest house is a limited company, not them personally. Principal private residence relief is a personal capital gains exemption. There's also a letting exemption of up to £40,000 if you let out rooms in your house while you're there, which they can also claim. The other benefit is you can claim something like capital allowances reliefs, and capital allowances reliefs you can claim on integral features. So if they buy the guest house, it's got radiators, it's got lifts, it's got boilers, integral features upon which you can make a claim if it hasn't been claimed before. Then what happens, I said, what's the profit going to be like? Well, there won't be a profit in the first year. We need to get our feet under the table. We're going to do the rooms up. We're going to spend quite a lot on repairs and decorations. So we're going to make a loss. We might even make a loss in the second year. So I said, did you know there's a relief that says that loss in the first year, when you set up a sole trading business, which you can only claim if you're a sole trader or partnership. So my suggestion is that they buy it personally and they have a partnership, husband and wife, then that loss can be carried back against his PAYE income. You can carry it back 3 years. So he can get a PAYE tax refund for his PAYE income, because the government say, if you start a business as a sole trader and you make a loss, that's not unusual, because you need to build up goodwill, you need to get customers, and you need to sort of bread upon waters, you've got to go around, get some business in, etc. So we're going to give you a relief that if you make a loss as a sole trader or a partnership, you can carry that back against PAYE income in the previous years. So I worked out some rough numbers, and I reckon we saved him about £250,000 over that lot. Because if you think about it, if I have a guest house, and this is generally for properties anyway, I've got a guest house in a limited company. So, and this follows the example I gave you earlier. So the guest house, owned by a limited company, the company pays chargeable gains tax. Individuals pay capital gains tax, company pay chargeable gains. Chargeable gains tax is when you sell an asset in a limited company, levied at the same rate of the current rate of corporation tax, which is 25%. So let's use some round numbers. They bought the guest house for £1 million, and let's say in 15 years they sold it for £2 million. Made a £1 million gain. That £1 million gain will be subject to 25% corporation tax in the company. Then they want the money out. So they're going to pay 25% on £1 million, and then they need to get that £750,000 profit. £1 million times 75% is what's left after paying 25% corporation tax. Need to get the money out. How do I get it out? Oh, let's take a dividend. 39.35% on the balance. Just do the numbers. And that's all because the accountant never thought about it, never put his thinking cap on. So we are chartered certified accountants, which means that we have a professional body that we come under. But unlike solicitor, accountant isn't a legally privileged word. So if any of you want to set up tomorrow ABC Limited, call yourself accountants, nothing's stopping you. But the point is that you won't have professional indemnity insurance, you won't be regulated by a professional body, and if something goes wrong, there's no professional body to complain to. So if your accountant is in that position, we sometimes have people come to us and said, well, I got him because he's really cheap. But then the fines for not doing the accounts properly from Companies House and HMRC are generally more than they saved in accountancy fees anyway. So you've got to be careful about the structures that you set yourself up in, because in that instance, they couldn't have claimed capital gains tax relief on the principal private residence because they live there, because it's owned by a limited company. They couldn't claim the letting relief because that was owned by a limited company. And they wouldn't be able to claim the loss offset against the PAYE because the loss would be in the limited company, not in them personally. So you've got to sort of think about how you set your structures up. And the thing about structures is it's not just let's do it because it's really easy. It's all tax planning has to be done in advance, not in arrears. If that guy came to me 3 years later, he's already got the property in the limited company. We then got to get it out of the company, which will trigger probably chargeable gains in the company, probably SDLT, and it will all be very expensive. So, and then he would have lost the relief to carry it. By then the business would have probably might have had some losses. How do you soak up the losses before you get rid of it? There's a lot of things that you'd have to take on board when you think about sort of structures like that. But what a lot of people don't do is they sort of say, well, Yeah, but that's great. They don't think of what's happening down the line. So some of the tax planning we're doing is, in that case, the tax planning was when they exit, when they sell the property, which could be 15 years. Some tax planning we need to do, say, for inheritance tax is 7 years. Company buyback of shares, 5 years. But unless you're doing that, by the time you say, look, someone rings you up and says, oh, I'd like to sell the company now, too late, because that tax planning wasn't done. So you've got to sort of think about it. So, like, I'll give you an example. A guy rang me up and he said, I've seen one of your videos and I'd like to claim business asset disposal relief. I said, do you qualify? Yeah, of course I qualify. Okay. If you don't mind, I'll just run through it. You're directors of the company? Yeah, my wife and I have had the company for 7 years. We're both directors. It's a trading company. Yeah, we sell widgets. We've been doing it for 7 years. Okay. And you own you own more than 5% of the shares? Well, of course I do, because I own the holding company. I own 100% of it. Wait a minute, what do you mean? You don't own this company? Well, I own 100% of the company that owns that company, so I own all the shares. No, you don't. The one that's selling it is the holding company. Are you selling the holding company? No, because I've got some property in there. I'm selling that. Well, who is that selling that? The owner of that company is this company, and he owns all the shares in that company. So then you don't qualify for bad R. So a lot of it is that people say, yeah, I do. No, you don't. So you've got to look at it. Another example is a company being taken over. And I think it was a tax case I was reading, and they said to the owner of the business, you're fantastic, but we got tons of directors. We don't need you as a director. That's fine, because I sold the company anyway. So we're going to make you redundant. Okay. So on the 30th September, we're going to make you redundant at 9 o'clock, and then we're going to buy the shares at 5 o'clock. Okay, yeah, fine. Do you qualify for bad R? Any ideas? Let's just think. When you sold the shares at 5 o'clock, did you own more than 5% of the company? Yes. Was it a trading company? Yes. Were you director or employee? No, because I was made redundant at 9 o'clock. So I don't qualify. So all that tax planning's out the window. So a lot of it is that the devil is in the detail, and if you've got someone advising you who has got blinkers on, they're not going to find it. So you just sort of got to be careful about how a lot of the stuff works, because it is the detail is the important stuff, and the detail is sort of what makes the difference. So what you'll probably find with a lot of this is you might now sort of got a feel of how the taxes interrelate with each other. There are lots of other taxes that she might tinker with. There's a packaging tax. You're probably aware that, I keep on thinking about this 20 billion that she says is a black hole. To give you an idea why that is so rubbish, the government have said that by 2035 we're getting rid of petrol and diesel cars. So you may be aware that of a gallon of petrol that you buy at the moment, of that about 75% is tax. Petrol and revenue tax and VAT. The government make about £35 billion out of that. If there is no petrol and no diesel being sold, where's the 35 billion coming from? Well, you're probably going to find there's toll roads, there's probably going to be péage, everything there is in Europe will end up coming here, because they've got to make up 35 billion. So at the moment, how much do I pay when I recharge my electric car? Well, if I did have an electric car and if I did have a charging point in my house, 5% is the VAT on electrics. Well, that's never going to make up to 35 billion. So the numbers are pretty horrendous when you think about the planning. So there's lots of stuff that's got to change because of those taxes. So somewhere along the line, there has to be a big rethink about how the taxes work. And if you go back to that Laffer curve, you can't, if this is the Laffer curve, they generally say about 40 or 45% is where you should be paying your tax. Above that, people say, sod that, I'm going to take my sandals and laptop and clear off. Now, 100 grand in Portugal, 200 grand in Italy. If I was Jim Ratcliffe paying £111 million a year, he went to Monaco, so he ain't paying any of it. But those are the type of numbers you're looking at. And just take you back, the top 1% of taxpayers pay 24% of all tax, and these are big earners, and that's the bit you're in danger of losing. So I want to give you some time to ask some questions. I think we've got about 15 minutes.
Yeah, 15 minutes after.
Okay. So I've sort of rambled along, giving you some ideas, but by all means, if you've got anything you want to ask me, and I'll have a sip of water.
Just whilst we're on the subject of transport, any news on the paper mile potentially coming in? That's a hot topic at the minute.
Well, I mean, I don't know, to be honest, but I mean, they've got to do something about it.
For the camera, so you get the thing. Can you repeat the question back as well, just in case?
Yeah, sure. So you're saying any news on the paper mile?
Yeah.
I don't know, to be honest, but somewhere along the line, something's got to change, and something like that will have to happen. But I don't know how they're going to suddenly generate 35 billion, but the numbers just don't stack up. So a lot of this stuff is that they're saying the tax horizon has got to change. It's got to change in a massive way, because if they are getting rid of a lot of these, say, diesel and petrol cars, which personally they've already extended, I think they're going to extend it again. I think the problem is that how do you make up what you're losing? So then there will be definitely new tax. There's probably carbon taxes coming in. There will be more of those, but in answer to your question, I think it will happen. I don't know when.
I've got one. We've spoken about Portugal and Italy, try and limit tax if you wanted to move abroad. I'm sure a few people in the room have heard about Dubai and maybe another option. Are there any, as the tax situation stands now, any other sort of options if you wanted to move offshore? And are there any other implications that we might not be aware of, like 90 days property ownership?
Yeah, loads.
Loads, good.
So let's take it one at a time. So at the moment, you may have heard of the concept of domicile and residence, and it's quite funny when you look at the papers how misleading they are. So to give you an idea, residence has got nothing to do whether I've got citizenship or anything like that. If I'm deemed to be resident in the UK, broadly, whether I've got property here and I'm here for more than 180 days, I'm going to pay UK tax. Domicile literally is it. The one I always use, who you hopefully everyone's heard of, a guy called Robert Maxwell. Robert Maxwell was non-UK domiciled, even though he lived all his life, or the bulk of his life, in Great Britain, in the largest council house in Great Britain, which is Headington Hall in Oxford, which is now part of Oxford Brookes University. But he was born in Czechoslovakia, and his avowed intent was to be buried at the Mount of Olives in Israel, which is where he was buried, and he had an Israeli will. So literally, at the risk of not damaging the microphone, literally your heart or abode has never resided in the UK. It's a very old concept, this. So that means that my heart, in his instance, has never been in the UK, because he was born outside the UK, he wanted to be buried outside the UK. In fact, he had a burial plot in the Mount of Olives in Israel, and he had an Israeli will. So therefore, that meant that in that situation, he was never deemed to be UK domiciled. He was UK resident, but not UK domiciled. So just because you live in the country doesn't make you domiciled. Now, we subsequently have a deemed domicile concept, which means that if you lived in the country for 15 out of the last 20 years, you're deemed domiciled in the UK. So a domicile is very difficult to change. Now, if I left to go to Dubai, then I would be non-UK resident, and it sort of doesn't matter what my domicile is, because if I'm non-UK resident and I've fulfilled the criteria necessary, i.e. sold my property. So to give you an example, when Richard Branson left the UK to go on to his desert island, he had to sell his Oxford property to his daughter, so he could keep it in the family, but he couldn't own it himself, because otherwise he'd have available accommodation. So if I'm non-UK resident, it doesn't matter whether I'm a domiciled or not, because I'm not subject to UK tax. Now, out of the G20 countries, I think there's only 3 that don't have an exit charge, and we are one of those. So if, say, I was resident in Canada and I left today, Canadian authorities will say, okay, let's just add this up. You've got a property that's worth this much, you've got shares in your company worth this much, this is your tax bill, so I want you to pay that at the airport before you clear off. And that's an exit charge. We haven't got an exit charge. Question is whether one's going to be brought in. Maybe. I think it'll be difficult. The other thing is wealth tax. We haven't got a wealth tax. Spain's got wealth tax, France got a wealth tax, Switzerland's got wealth tax. Wealth taxes, I think in Spain they bring in about 0.06%. They're not, even when your car is included in your wealth tax, they're difficult to administer, and they're not that, they don't bring that much tax in. So they talk about wealth tax, but don't know if it actually work. So there are a number of taxes that may be brought in, but I think those two are two of the more difficult ones, but they're capital taxes. So like I say, what they may tinker with is, I've mentioned that if I left the UK, sold the shares in my company after the 5th of April 25, I couldn't come back for 5 years. They might extend the 5 years to 10 years, something like that. And sometimes people say, well, I'm only going to do it when the kids have left home or done their schooling or whatever. So they might just make it more difficult for people for some of these capital taxes to kick in. And some people say, I want to go to Dubai, which you can, no tax authority in Dubai. But it's a case of some people sort of say, what's the family life there? What's the security aspects like, etc., etc. So there are a number of ones being touted, and you may have read in the paper, they'll say a lot of the people who are non-UK domiciled may be leaving as well. Well, if they're non-UK domiciled, the chances are they came from a foreign country anyway, and they may go back to that foreign country. So if I had a UK company and I moved to Dubai, I could still get dividends from my UK company, and we don't have the concept of withholding tax. If you go back to when I was a trainee, you had something called Advanced Corporation Tax, ACT, and companies used to pay that. But there's no tax, no withholding tax on dividends. So you could see something like that being brought in, because if I left today and went to work in or live in Dubai, my limited company in the UK could still carry on, and in the instance I gave you before, say that company made £4 million profit, it would still pay 25% corporation tax, but I wouldn't pay tax on the dividends because I'm non-UK resident, because I live in Dubai. So those dividends could go over there. So the problem you've got, though, is you can't manage and control a company. So it's that simple. My clients would be paying their checks to Wilkins Southworth BVI Limited. But you can't do that because my business is run from the UK. It's managed and controlled from the UK. So if it's managed and controlled from the UK, irregardless of whether it's owned by Wilkins Southworth BVI Limited, it's still going to be subject to UK tax because I'm sitting in the UK performing work in the UK. So those people would have to be careful how they run the company, how it is managed and controlled. So you may read about some directors that have all their board meetings in Jersey. And so they sort of try and justify that the business is managed and controlled from Jersey because they fly over there and they say that's the important decisions. So if it's possible to go overseas, and nowadays with laptops people can run their business from laptops, then they may be able to take advantage of some of these positions. And like I say, 100,000 euros a year in Portugal, 200,000 in Italy, it might sound a lot of you, but if you are the mega rich, that is not a lot. And that can cover over there, capital gains tax, inheritance tax, that's the full works. So there are those, it's sort of a bit of a joke when people say, oh, the trouble with this country, we're always easy on the rich because we've got the domicile rule. Well, every country has got a rule because they all want the rich people. And whether you call it habitual non-residents or you call it whatever you want, they're saying, come in, come in. I want the people that's going to pay their taxes. And if I get 200 grand a year out of them, well, that's better than some people, like nearly half the country, pay no tax. Someone's got to pay the tax to keep the thing going. So there'll always be rules like that because you want the rich people, because 1%, the top 1% pay 28% of all the tax in this country.
So the only really way of doing it is moving your company to Dubai as well?
Well, I couldn't move my company if I'm sitting in the UK, you see. If it is movable, if it's an internet company, then a lot of people can do that, yeah, sure. And a lot of people are and have and will. And they will continue doing that. So, and I think a lot of people are choosing sort of different locations. Like I say, one of my clients is thinking of Cyprus, and then it's just down to us to work out how it's going to work. And what they don't want is to go to Cyprus and then find that they've got a revenue inquiry. So there was a guy, I think I was reading about, an ex-footballer, I can't remember his name, went to Dubai and his company had an inquiry and he said, I'm not coming back. They said, well, you can do what you want, but we're still going to tax you here. It's tax the company. Because they said, we want you back to give evidence. So it's like anything, it's got to be planned properly. And depending on the structure and how your firms work, as to how easy that would be or not.
Quick question, Chris. Sorry. On that subject, so in terms of, as my company goes, we're talking to the accountant about the best advice. They were talking about stuff about setting up trustee accounts. You mentioned it slightly earlier. Are they a kind of serious thing to consider for sort of future-proofing for my kids and putting money in the trusts or business in the trust?
What are you thinking? This is for your kids?
Yeah.
But you're going to live in the UK?
Correct.
Okay. So what do you want to put in that trust?
A fund for later years.
But cash or?
Can be.
Okay. And how much are you talking about?
Enough. The conversation we were having the other day was them getting into or in a property of some sort as they grow up, because the values are going up. It's going to be almost unreachable for my little ones now by the time they get to 30s. It's having an opportunity for them to have a pot to get into without taxing the life out of it.
Okay. So what you've got to bear in mind is basically the lowest rate of tax in the trust is the highest rate of income tax, 45%. And trusts have a 10-year tax charge at 6% on the assets in the trust. So what you might want to consider, and trusts are expensive, what you might want to consider is like we are doing things like family investment companies. So in family investment companies, say you set up a company today and you could say, I'm having 5 classes of shares. Let's assume you've got 3 kids. So you have A shares, your wife has B shares, child 1 C, child 2 D, child 3 E. Then if you wanted to, you could set up the company there where you have 1 share, your wife has say 2 shares, so that's 3, and they have 97 shares. And if that was the case, they own 97% of the company, and then as the company trades, then their asset is that, and then they can take dividends when they're no longer minors. If they take dividends while they're minors, i.e. below 18, it's taxed on you if you set it up. So what you want to do is that we often set up structures for university fees, things like that, and that structure would cater for that. And it generally is a much cheaper and easier to run than a trust. You can put some safeguards in. So I always say, not disparaging your kids, but I had a client who came to me and he said, Chris, I want to buy a property for my son, and so he can get the property ladder. And I said, fine, how are you going to do that? And he said, well, I've got a couple of million, I'll buy the property and put it in his name. Okay. Do you want a 16-year-old owning a property? This isn't a tax answer, but do you actually want that? And he said, yeah, I suppose so. So I had another chat with him about 5 years later, and he said, I'm so glad I never did that, because he was stuck in putting stuff up his nose and he'd be dead now. And so you've got to think, do you want a 16-year-old having a £2 million property? And then the other thing is, say that isn't an issue. Will they go and put black on the casino, it all on the casino? Will they have a bad marriage and it all disappears to the ex-partner? Sort of, you've got to make sure that you plan for safeguards and things like that, and you just want to make sure that you do this fantastic scheme and it's screwed up, not by your fault, but something that happens to them, and it may not be their fault. Don't know. But what you need to do is that you need to put strictures in place to ensure that if the worst that happens, there are ways to mitigate that.
So we'd like a pension option, like paying into it. The same concept we had, we were talking about buying a house before, weirdly, because it's come up for sale next to us. So we were talking about doing the same thing, and that's...
How old are they?
Talk about that.
How old are they?
Mine, 10 and 5.
Okay. So that would be probably a bare trust if you had it in their name, but and the income would probably going to be taxed on you. But you just need to make sure that the planning's done correctly. If you had that in a limited company, you'd be subject to ATED. Heard of ATED? Yes?
No, ATED, no.
Yeah, okay. So again, if I say so myself, I've got this great one on our website about ATED, about my apocryphal conversation with Mick Jagger. So Mick Jagger at one stage, when he was with Jerry Hall, he lived not too far from me in Richmond, and he had a £20 million property. And so my conversation, like I say, is apocryphal, is I go to Mick and say, Mick, great property, and let's assume I did have 20 million, which I don't. And I say, Mick, I buy it, it's fantastic. He said, to you, Chris, 23 million. I said, 23, what are you talking about? He said, simple, you're going to pay 15% SDLT on this property, because I already own my own house. So 15% on 20 million is 23 million. However, my property is owned by my BVI company. This is true. So he owned that property by a BVI company. So if the company, I bought the shares in the company, I'd only pay 0.5% stamp duty. So I've saved 14.5%. So the government said, well, this is a bit crazy. We're going to lose money hand over fist if everyone does that. And Mick did do that. It's quite shrewd with the tax. So they brought in ATED and they said, well, how the hell is this going to work? And he said, well, simple. ATED is if the property is owned by a non-natural person, limited company, trust, something like that, non-natural person. If it's owned by an individual, you don't come under ATED. So this is my investment property that I rent out, and it's owned by my limited company, so I'm going to pay ATED. And they said, well, what we'll do is if the property's worth, let's say, £1 million or more, then you have to pay ATED. And if you don't register, and you should have registered, then you'll get fined as well. So with ATED, they said, how much money will this bring in? So I don't know. But in the first month, 3 months, it brought in more money than they planned for the whole year. So this is a good wheeze. Let's reduce the value of the property from £1 million down to £500,000. And the same thing happened. So now they've reduced it to £250,000. So if you've got a £250,000 property valued or more, that's not the purchase price, that's its current value, in a non-natural person, trust, which could come and hit you if it's in a trust, limited company, ATED hits you. So I think it's Donald Rumsfeld that says there's the known knowns and the unknown knowns. And what you don't know is what you don't know. And the trouble then is what you don't want to do is find some tax comes up and bites you on the bum because no one ever told you about it. But that's ATED. So when you go into these structures, what you're doing, sir, is trying to protect yourself from one tax and you might get hit by another tax. Sorry, did they get that question on there or do you want me to repeat it?
Repeat the question anyway, I'm sure you're cutting out it.
So what we're talking about here is if you buy a property for children in, say, a trust, and what we've got to do is to try and plan for the tax implications on the trust. And what I was saying is a family investment company may be a better vehicle, but in both instances you've got a plan that you don't get it into a structure that triggers different tax. In this tax, if it's a property, then you've got to be aware of ATED, annual tax on envelope dwellings. An envelope dwelling, it rolls off the tongue, madam, yes. Envelope dwelling is a non-natural person, and a lot of it relates to rich oligarchs own it in trusts, limited companies. A lot of these are overseas entities, and so if, say, I've got a non-UK domiciled person that got a BVI trust that's bought a property in Chelsea for 50 million, and I live in it, then that's the way it triggers ATED. So that's that one.
So just on that, so is that only if you leave it for your kids, or is that general with the ATED?
No, anyone can get hit by ATED. So if I
set up a business, property business, bought a few properties, I need to be aware of ATED?
Well, ATED, it only hits residential properties, and if you rent the property out. Now, if you rent it out to a third party, i.e. not you or a family member, then ATED you may not have an ATED liability, but you still have to register. And if you don't register, there's a fine. So ATED, annual tax and envelope dwellings. Just going to change his tax structure. He just realised. So that's only if you rent out a residential property.
We've got time for about another 2 questions if you've got them. Yeah.
In terms of property portfolios, if they're all on interest-only mortgages, how does that work in terms of? Am I right in thinking that, say, I was a lot older than I am now, and I needed to go into a home, for example? Am I right in thinking that HMRC can't get their hands on that property because I don't actually own it?
A minute, so let's, for the sake of the camera, you've got residential property you rent out on interest-only mortgages,
Yeah.
and you own them yourself?
Some myself, some limited company.
In a limited company?
Pardon?
You're in a limited company?
Some are.
Okay, and who owns the shares in the limited company?
Myself, my business partner, and
So I'm not quite sure what you're avoiding. I mean, if I've got a property of £500,000, if I own it personally or own it in a limited company and own the shares, then you still own it, don't you? So you can't go to the council and say, I want to go in a home, but I've got no money. And they'll say, well, you've got the shares and you own 100% of the company that owns all these properties. Isn't that the sort of same answer?
no, it's alright. I just had been told that if it's something that you don't own, then that's all you own.
But you own the company that owns the property.
But even if it's in your own name, is that the same?
Well, my understanding of the way that if you go in a home, then presumably you're going to say to the council, I've got no assets and no money. Is that the contention?
What I'd heard, yeah.
I'm not quite sure how you could run an argument to say I've got no assets when you own a company that owns the property.
But if you own it in your personal name.
Well, whether you own the property in your personal name or you own the company that owns the property, it comes back to the same thing, doesn't it?
But if you've got an interest-only mortgage on it, so which is still running, then the mortgage company owns it.
No.
No?
You own the property and you have a debt to the mortgage company. If I buy a property today for £500,000 on a mortgage of £500,000, then there is no equity in that property. If the property value goes up and I go in a home, then presumably the equity is the difference in the two. So that if that mortgage, if you're paying the interest on, the mortgage hasn't increased, but the property value's increased. So therefore that's the equity, and the equity is what the market value of the property is, which will be more than what the mortgage is. Sorry, didn't get you out there.
Chris, if you were just starting out in business now with everything that you know, what things would you put into place for pre-planning?
With regards
if
to
you had
what?
a trading business and you were just starting out again as a new business.
Well, if I had a trading business, I guess it sort of comes back to my earlier question. So if I need £100,000 a year to live on, and if it makes £100,000 a year, then I know that all the profits of my limited company I will need to live on.
Yeah.
So therefore, I would then question whether I want a limited company. If you say that's year one, in year 6 it's going to make £10 million and I still only need £100,000 to live on, then it might be the right structure. But generally what I find is as businesses grow, what was good for the structure when you first started the business isn't necessarily the same structure you need going forwards. And what surprised me is that we have a client that came to us probably 13 years ago, and we said to them, haven't you got this structure? And they said, well, accountants never sort of thought about it. And a lot of it is they said, well, we just do the accounts the same as we did last year. But if you never sort of look at the structure and say, well, actually, it may be time to change this, then you're just going to do what you did last year. But what you've got to do is really review it each year to see whether it's the right structure for you. But it's just continually reviewing it. I mean, I always say, if I go to my doctor and he doesn't keep up with the legislation and I've got a headache, he'll give me the best headache tablet 5 years ago because he doesn't know what the best headache tablet is now. If your accountant isn't keeping abreast of the tax legislation, so the autumn statement will change a lot, the Companies Act law, employment law, things like that, you're never going to be able to give best tax advice. And the point is you just want to make sure that you actually got best tax advice for your structure. Now, if your structure is you earned £100,000 when you first started the business 20 years ago and you're still on £100,000, it may be the best structure. But the point is, if you never look at it, but I can guarantee that probably what's going to happen on the 30th of October will affect a lot of people in this room. Not now, but if you haven't planned for the changes to inheritance tax, changes to capital gains tax, then when you come to exit or when your death occurs, you might find that you haven't planned it properly. And that's the thing to do.
One more, Stuart.
Well, it's an off-ball one. Could I use charity donations to reduce my tax?
What, are you saying you're just making a gift to charity to reduce tax? Or because you want to do it?
I want to do it.
Is the charity called the Stuart Middleton?
Slush fund. No, it's not about. I suppose it depends on which angle you look at it. It was in a genuine concern, but like I say, if it was a case, to my eyes, I'd rather give the money to a charity than pay the tax man. But what I'm saying, like, I'm sorry, I don't know what the cut-off rate of a certain thing is. But like, for example, if I reached £100,000 and I had to pay tax on that, and it was a certain percentage, and I've ticked over the rate to pay that, but I turned around and I went, well, if I donate £50,000 to charity, does it bring me? Does it then? Do I drop down the tax band, or is it a completely just separate thing altogether?
So the first thing I always say is never do something just for tax. Because in that instance, if you're earning 100,000, you're a 40% taxpayer. So that means that if you give away 100 quid, you've still given 60 quid of your own money away, because the tax savings is 40 quid. So the point is that then you want to make sure that the boot's not on the wrong foot. I mean, if you want to give it away, and you will get tax relief on gifts to charity, yes, and it will be tax deductible, yes. So broadly what happens is that you'll get 20% tax relief at source, so that's grossed up, and then if you're a 40% taxpayer, you get another 20% relief in your tax return. So you're going to get 40% tax relief, but don't do it just for tax. If you want to be magnanimous and make a gift to charity, then do it.
No, Stuart.
There you go. No. Lovely. We all had fun with Chris?
Yeah,
Yeah, positive advice? Yeah. Can we have a round of applause for that?